Okay, let's admit it, this market's a mess. At every turn, there's a new problem, whether it's skyrocketing inflation or this world order changing war in the Ukraine or out of control oil prices or rising interest rates. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the professional traders on our desk know that at times like these are actually fantastic opportunities all over the place in the options world if you know how to spot them. In today's video, we'll be sharing with you a strategy that can be used to turn these kinds of circumstances into outstanding profit opportunities. So if that sounds like something you'd like to learn more about, then stick around. I think you're going to be pleasantly surprised at all of the great outcomes that can emerge from this single option strategy we're about to teach you. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so it's no secret that we're in a sell-off that has been going on since the beginning of the year, and there's no better way to illustrate that than to take a look at this year's price chart of the SPY, which is the ETF representing, of course, the S&P 500 index. And as you can see, we've pushed down close to 12% from its 2022 highs, which is technically a correction, which can turn into a flat-out bear market if this sell-off continues much longer. And so when these kinds of moves take place, which are a normal part of the market cycle, there's a particular option strategy that can be deployed that can pay big dividends if you learn it and apply it with some skill. Now, before we get into the details of this option strategy, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction of the stock, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. The strategy that I'll be teaching today involves SPY stock options, and I realize that most of you probably know something about how stock options work, but just for a quick review, and this is going to be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before the option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below the market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. Okay, so with that in mind, on Monday of this past week, the SPY closed at 416.98. So suppose that on that day, near the close, you were to go out to the June options chain for SPY options about 3 months out and bought a call at 421, just 4 points above the current market price, and sold 2 puts at the 375 strike, which is more than 40 points below the current market price. Well, if you were to do that, then you'd be executing a modification of an option strategy known as a risk reversal. And it's a strategy that options professionals use all the time. Now, let's take a look at the cash flow of this initial trade so that you can understand what has happened here and the implications of that cash flow. So as you can see, selling those two 375 puts, you received the price of 1063. But remember, each of those puts represents 100 shares of SPY. And so you'd multiply that by 100, and you sold 2 of them. And so multiplying it all out, you receive $2,216 for those puts. And that cash goes right into your account. Now, on the other hand, you paid a price of $19.77 for the call up at 421, only 4 points from the market price. The market wouldn't have to rally very much for that to start to gain some serious value. And so after completing the transaction, the cash flow was positive in the amount of $239 after deducting out the cost of the call from the proceeds of the 2 puts. Now, I'd like you to take a look at a price chart of the SPY going back over a year. And as you can see, the SPY has not traded as low as 375 for over a year. And there are plenty of traders and investors who regret not having bought more shares of SPY a year ago, given that it ran up more than 100 points since then, although it has backed off. And so the reason I'm pointing this out is because if the SPY were to sell off further, and by June it's actually trading below 375, then the owner of those puts will exercise those puts, and we'd be obligated to buy 200 shares of SPY at 375 under the terms of our put contract. And so in that scenario, we'd still have the $239, and we'd own SPY shares at a price that is nearly 22% lower than its high this year, which is a tremendous discount in the long run. You'd basically be turning the clock back to the beginning of 2021 and be buying in at those prices. So that is one outcome of this trade, and the puts get assigned. We buy the shares at 375, and the call we bought just expires with no value because the right to buy 100 shares of SPY at 421 obviously has no value if the SPY were trading at lower than 375 in June. And of course, we'd still get to keep that initial $229 in cash flow that we received originally. We keep that no matter what. Okay, so that's one way that this kind of trade can play out. But let's think of another way that this trade can play out, and I want to give you a historical example. And so if you head back to September 20 of 2021, as you can see, the SPY at that time was trading around 432, having sold off about 5% from its all-time high at that time, which was 454 at that point. And so let's say on that day, last year, you did almost exactly the same thing. You sold 2 of those 390 puts expiring in December, about 3 months later, which are a little more than 40 points below the market, and you bought the 437 call about 5 points above the market, almost the exact same trade, paralleling the example we just gave you. And as you can see, again, we had positive cash flow, but in this case, it was a bit less because the market was less volatile than it is these days. And so you received, in this case, positive cash flow of $141. Now, let's move forward to December 15th, a few days before these options were due to expire. And as you can see, the SPY bounced after an initial sell-off and rallied to 470.35 by the end of the day on December 15th. So looking at the modified risk reversal trade on that day, as you can see, the 437 call is now worth $33.05. Why? Well, the SPY is trading up at 470.35, which means that if we exercised our call option today, the call seller would be forced to sell them to us for $437 a share, whereas they're trading now at 470.35 in the open market. So subtracting the market price from the strike price yields you a value of $33.35 per share, and we have the right to acquire 100 of those SPY shares at 437, and so the total value of the calls at the end of the day was $3,335. And if we bought back those two puts for 1 cent to close that short put position, as you can see, it would only cost us just $2. And of course, we need to add back in the 141 of initial cash flow from the trade for a final profit of $3,474. So this 2021 trade is an example of where you never actually acquire the shares at a big discount to where they were trading before. Instead, you cash in the call for a great profit and add back the cash flow that you initially received on the trade. And so if you think about it, there were actually only 3 possible scenarios for this trade in late 2021. The first one is that the SPY keeps selling off and expires below 390, in which case you'd own SPY shares at 390 at a 17% discount below the SPY's all-time highs, plus you get to keep that initial $141. Now in the second case, in this scenario we haven't discussed yet, but SPY could close between the short call and the short puts. In other words, between 390 and 437, in which case all of the options would have no value. Why? Because there's no value to the right to buy shares at 437 when they're trading below that, and there's no value to the right to sell shares at 390 when the market's trading above that. So they both expire worthless, and yet you'd still get to keep the $141. So that's like a consolation prize if the market never bounces, but instead just flatlines. So you make money in that scenario, not a lot, but you still make something. And then of course, there's the third scenario, which we just discussed, where you keep the initial cash flow plus the market does bounce and you receive 100 times the difference between that market price and the 437 strike price, which in this case came to more than $3,000. And so what I'd like you to take away from today's video is the fact that sell-offs like the one we're experiencing in the market right now give rise to these unique opportunities where, in a sense, every outcome is favorable. With this modified risk reversal trade, you either end up owning the shares at a price you'd love to own them, a huge discount from the market highs, and you keep the initial cash flow. Or you end up making just the initial cash flow, or you end up making the original cash flow plus whatever value the call has become towards the end of the trade, which in the case of a significant bounce, as we saw in this case, was a really nice profit. Professional options traders know how to spot and exploit these kinds of situations in sell-offs, and now you're trained to do the same thing. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free workshop. So click the link to sign up now before you miss it.